Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents companies hope you won't read too closely. Today we're tackling Albemarle Corporation's latest proxy statements, so you can see what the board is suggesting to their shareholders for their upcoming annual meeting. Albemarle wants you to know they're all about values and long-term shareholder value. They're happy with their performance despite what they call industry headwinds, claiming they've maintained industry leadership. In short, they think they're doing great in energy storage and bromine and lithium specialties. They're saying they've been cutting costs and being smart about capital. Let's start with the cost cuts. They say they've already gotten more than halfway to their goal of slashing $300 to $400 million in costs by the end of last year. They've also reduced capital expenses by over $450 million. The company also stopped construction at Kemerton Trains 3 and 4 and placed Kemerton Train 2 into care and maintenance. In early 2025, they also announced placing their Chengdu Train 25. They also announced placing their Chengdu Train 2 into care and maintenance in early 2025 at all about optimizing the network, in their words. The board is serious about hearing from their shareholders. They talked with over 245 of them and used that feedback to shape their sustainability, human capital efforts, governance, and compensation programs. Albemarle also raised its dividend for 30 years in a row. Alright, let's get down to the meeting itself. It's set for May 6, 2025 at their headquarters in Charlotte. There are 4 key items to vote on. First, there's the election of 10 directors to the board. The board is recommending you vote for all of them. Second, there's a non-binding vote on executive compensation, an advisory vote on whether you approve of how the top dogs are getting paid. The board unsurprisingly recommends you vote for. Third, you're asked to ratify the appointment of PricewaterhouseCoopers L independent auditor. Again, the recommendation is for. Finally, there's a shareholder proposal regarding simple majority voting. The board's stance, OG&T. They want to keep some supermajority vote requirements in place, particularly for affiliated transactions. Let's size up the board itself. It's mostly independent, with 9 out of 10 directors meeting the independence criteria. The average age is around 65 and they've each served about 8 years. They have expertise ranging from public company leadership and relevant industry experience to financial literacy and risk management. There's also a table that indicates what each member is competent in. The document highlights board independence, director education, and a retirement policy. They also do annual board and committee evaluations to stay sharp. There are 5 standing committees plus an executive committee. Let's quickly check out what they're paying their auditor, PricewaterhouseCoopers. In 2024, audit fees were about $5.4 million. They paid another $258,500 for audit-related services and some other fees. In all, it amounted to $5.7 million. Now onto the really juicy stuff, executive compensation. It aims to attract and keep talented executives, motivate them to hit business goals, and align their interest with the shareholders. Their compensation philosophy rewards performance, benchmarks against peers, aligns incentives, and avoids poor governance practices. Here are the NEOs for 2024. J. Kent Masters Jr., Neil R. Shiori, Melissa H. Anderson, Netha N. Johnson Jr., Eric W. Norris, and Kristen M. Coleman, who previously served as the company's former executive vice president and corporate secretary, who separated from Albemarle in early November. They had some feedback from shareholders. A lot of changes were suggested, all to encourage a strong corporate government. The committee also reviews the compensation peer group based on quantitative and qualitative and qualitative and qualitative and qualitative criteria on an annual basis, and no changes were made for 2025. This decision was reached after the peer group assessment was revisited later in the year. The company says their pay strongly correlates with Albemarle's actual performance, especially their total shareholder return. The committee decided to use negative discretion to lower the overall payout by 34 percentage points, to align it with the underlying business performance. They mentioned the impact of lithium prices and changes to the incentive plan metrics to keep things on track. They even decided to replace adjusted cash flow from operations with the operating cash flow conversion rate. Executive pay will continue to correlate with total shareholder return, but the incentives need to align with shareholder and company goals. It remains a challenge for the board to best reflect performance. Looking into each individual compensation element, base salary is fixed and recognizes skills and performance of executives. Pay is also primarily at risk. They mention an incentive program with equity awards. Here are the numbers in the summary compensation table itself, so you can see who got paid what. Gay Kent Masters, for example, received over 14 million, and there are base salary, bonus, stock awards, option awards, non-equity incentive plan compensation, and a number of other factors. Looking at this table and seeing the stock awards, a trend seems to be that most executives receive most of their payment in stock options. Albemarle does take risk management seriously. They've got policies in place against insider trading, hedging, and pledging company stock. They also have policies to recoup compensation if things go wrong. What about the regular worker? The ratio of CEO to median employee pay is 212:1. This is based on a calculation of each employee's pay and stock. The stock awards, and specifically its assumptions, seem to be the key to all payments. Make sure the management are not over-rewarded, because that seems to be the primary place the payment happens. Finally, the proposal to adopt a simple majority vote. There is an overwhelming support. Question is why they haven't initiated this on their own. Seems to be a common theme among a number of shareholders. The company responds saying they have undertaken a review of the bylaws looking into eliminating supermajority shareholder vote provisions and is not necessary in light of current actions. Now for my take on all of this. Albemarle is trying to navigate a really tough market right now, with volatile lithium prices impacting their bottom line. Their cost-cutting measures and focus on cash flow are definitely steps in the right direction, but whether they're enough remains to be seen. One of the strengths of the firm is that it is the largest lithium supplier to the electric vehicle battery markets, a market projected to increase in the coming years. But the risk that those prices do not grow might make the company seem weak. Their shareholder engagement is commendable. You can tell they're at least listening to investors. But their executive compensation program feels a bit disconnected from the reality of their current financial performance. They need to be careful and transparent. Overall, Albemarle is facing significant headwinds. The board needs to show it is actively working to improve the company's value and increase stakeholder trust through compensation changes or other factors. Thanks for watching. If you found this corporate deep dive helpful, don't forget to like, comment, and subscribe.